We have now reached the fourth and final segment in this very long reading on alternative investments, and in this segment we will talk about closely held companies, distressed securities and commodities. First, closely held securities, and we need to understand what we mean by closely held companies or closely held securities. Essentially, these are equity or ownership shares which are not publicly traded and not subject to reporting and disclosure regulations. So as an example, if your uncle has set up a small private company, now this company, obviously shares of this company might be held by 3 family members. So these shares are owned by the family members and these shares are obviously not publicly traded. So here we are talking about a closely held company. Now these closely held companies can take on several legal structures. They could be corporations, they could be set up as partnerships or sole proprietorships, and then within corporations there can be subcategories such as tax advantaged corporations or regular corporations and so on. But as long as you understand the point that closely held companies can take on a range of legal structures, that's what you really need to know. The other important point with closely held companies is that the legal definitions of intrinsic value, fundamental value and fair value can differ among different jurisdictions, and these definitions can also differ from what you have studied in finance. So it is important then to understand the law related to closely held companies, and especially if there are some lawsuit issues or litigation issues and you need to determine the value of a given closely held company, how do you do that? And fortunately for us, we don't need to get into details, but all we need to know is that if there are any legal issues and we need to determine the value, then we need to understand both finance as well as the law related to closely held companies. High level stuff, but that's what you need to know at this stage. Now, what we can very briefly cover is the different valuation approaches, and this is purely from a finance perspective at this stage. These approaches might look familiar. So 3 possible approaches for valuing a closely held company. One is the cost approach. So you simply figure out what is the cost of getting the company to the level it currently is at. The second is a comparables approach, where you try to find a comparable company, maybe a comparable public company, and then use the comparables to come up with the value of this closely held company. And finally, you can use an income approach, which essentially is the discounted cash flow approach. So you project the cash flows, the net cash flows, and then discount back to come up with the value of the company. The curriculum just spends a few lines on each of these, so I don't think, as long as you know these terms, I think that's fine. I don't expect a quantitative question on this material. But at the high level, you should also understand the concept of discounts and premiums in the context of closely held companies. Let's say that based on these methods, you come up with a value for a closely held company to be 100 million. Then realize that since the shares of closely held companies are not very liquid and not very marketable, then if you are buying this company, because of this lack of liquidity and marketability, what you will pay is less than the 100 million. So if you then actually pay only 95 million for this company, then essentially we are saying that there is a 5% discount due to lack of liquidity. Next, a discount for lack of control. So if you buy a 20% stake in the company mentioned above, and let's say that the other party has a 80% stake, clearly the control of the company is with this other majority owner who has 80% stake. So you are to some extent at the mercy of the larger owner, and hence if we simply go back to the value of 100 million and say 20% of 100 million is 20 million, you might end up paying less than 20 million, and let's say if you pay 18 million, that 2 million is a discount because of the lack of control. Premium for controlling interest, this should be obvious now. If you are purchasing a controlling interest, then you have the flexibility to improve the company operations and potentially increase the value of a company. And if you do have a controlling interest, then you might end up paying more than the value defined over here. So that would be referred to as a premium for controlling interest. Again, I don't expect quantitative questions on this, but as long as you understand these terms, you should be fine. Next, we'll talk about distressed securities, and obviously the first question is, what do we mean by distressed securities? Essentially, we are talking about companies that are in financial distress, and specifically companies which are either about to go bankrupt or have filed for bankruptcy protection or are trying to avoid bankruptcy through some form of debt restructuring and are trying to do this out of court. So that's the basic definition. Now, before we move on, let's just understand that there is an inherent conflict between the bondholders and shareholders, and this is going to be particularly apparent in distressed companies. Why? Because as you've studied before, a company that might be going bankrupt and might have various liquidity issues, bondholders have the first claim on the underlying assets. So if the underlying assets can be sold for a certain amount of money, the bondholders have the first claim on that, and hence it might be in their incentive to just liquidate the company. Shareholders, on the other hand, will lose out if the company is liquidated and the money goes to bondholders. Hence, what shareholders would really want is to somehow turn the company around so share prices go up. Because of this reason, a common strategy to invest in distressed securities is through convertible bonds. So the idea there is that an investor buys convertible bonds or invests in convertible bonds on the underlying distressed company, and then hopefully if the company can be turned around, then it would make sense to convert these bonds into equity. So very often you see convertible bonds used in the context of distressed securities or distressed companies. The characteristics of distressed securities investing, you will notice that these are quite similar to what you saw for venture capital. Distressed security investing is obviously the underlying security is clearly illiquid, in the sense that if you do invest in such convertible bonds or even in equities, chances are that it will take some time before you can make money on this. So typically these will not be easy to sell at market price, and obviously there is going to be a relatively long time horizon. There is likely to be heavy involvement by investors. So investors will have an interest in trying to turn the company around and get involved to some extent with management and strategic direction and essentially helping change the fortunes of the company. And extensive analytical work is involved, because investors, when they are evaluating a distressed company, one has to figure out whether it is possible to turn this company around. So does the company have a viable business? If the company purely has financial issues and you work out that as long as you solve the financial issues, the underlying business of the company can be strong, then it might make sense to make such investments. So not only do you need to do your financial models and your finance oriented calculations, you also need to very carefully analyze the underlying business, which applies in general with equity investing, but obviously more so with distressed securities. And then distressed securities actually can be viewed as the ultimate form of value investing, because With distressed securities, the enterprise value or the market value of the security is going to be very low, and potentially, because this company is in distress, it is possible that the enterprise value is even lower than what it should be. And if you invest sensibly in distressed securities where there is potential for growth and where you are convinced that enterprise value is far lower than what it should be, then there is a potential to make a lot of money on these investments. Finally, we'll talk about investing in commodities, and a core point with commodities is that it gives you exposure to an economy or a sector's growth. A classic example is the textile sector. So when the textile sector in your country is growing, obviously the value of the underlying commodity, which is cotton, will go up. Commodity investment is mostly done indirectly. So if you want to invest in cotton as an investor, it's unlikely that you go buy many tons of cotton. The more likely scenario is that you will invest in commodity futures. And we have commodity futures for agricultural products such as cotton, wheat, corn, etc. Metals such as gold, silver, copper, energy, and so on. So we have different commodity futures that are quite actively traded around the world. We can also invest in bonds which are indexed to some commodity price. So the payments that these bonds make go up based on the price of well-defined or some defined underlying commodities. Or investors could buy stocks of companies that are producing commodities. So if the underlying commodities become more valuable, then the stock price of these companies will go up. As we talk about the motivation and investment vehicles, we should first understand a few critical points related to commodities. One is that it's been historically seen that there is a relatively low to negative correlation with stocks and bonds. So this means that when we look at the correlation between commodities and stocks, as well as the correlation between commodities and bonds, this is relatively low. Now, for a portfolio manager, this is very important, as I will describe very briefly. And also, we have noticed that there is a high correlation with unexpected inflation. Now, these 2 points are extremely important. Why? Because if you are a passive investor and you are looking for an inflation hedge, so when inflation goes up, you want your underlying asset to go up. So that would be an inflation hedge. And given this high correlation that commodities have with unexpected inflation, commodities provide a great hedge against inflation. Diversification benefit, so that's this point over here. Given the relatively low correlation that commodities have with our classic investments in stocks and bonds, clearly if this correlation is low, then adding some commodity to our portfolio is going to give us a diversification benefit. We don't need to get into the details, but it has been shown that between a 5 to 10%, if 5 to 10% of our portfolio is put in commodities or some sort of a commodity index, that gives a reasonable amount of diversification benefit. So we can maybe keep the same expected return while reducing the riskiness of our portfolio. And a general point that is made in this reading is that passive investors will be looking for an inflation hedge or a diversification benefit when they invest in commodities. A commonly used investment vehicle when we talk about commodities is a collateralized futures fund. This is offered by some financial institutions, and the way it works is as follows. If let's say you put in $1 million into a collateralized futures fund, what will happen is you will get a long position in an underlying futures contract, which that futures contract might be based on some investable index, but nevertheless, if you put in $1 million, you get a long position in the futures contract, and $1 million worth of T-bills are bought in your account. So these T-bills can be thought of as collateral. So you have $1 million collateral in the form of T-bills and a $1 million long position in the futures contract. So what is your return now? There are fundamentally two sources of return. If the contract value goes up, then you benefit, and obviously the return that you are getting on the T-bills is also the second source of return for a investor in the collateralized futures fund. In terms of active investors, they are basically speculating on the near-term direction of commodity prices. So active investors are essentially speculating. If a speculator believes that the price of gold will go up, he is not really worrying about inflation hedge or diversification benefit. If he is simply speculating that gold prices will go up, then we would refer to him as an active investor. So that is it. We are done with this very long reading. There are a lot of questions in the curriculum, so I want you to practice those questions very hard. If you have any comments in general about these four parts that I have just gone over, please post your comments on YouTube, and if you liked these videos, then please click on the like button.